earlier today, Ralph Eads, chairman of energy investment banking at the Jefferies Group, moderated a panel at the Milken Conference on energy security. From the turmoil in the Middle East to the BP oil spill, he and speakers such as T. Boone Pickens talked about the vulnerabilities of the U.S. energy supply. But we want to talk to Mr. Eads about how it all affects his day job, deal making in the energy business. He's here now to discuss just that with us. Ralph, thanks for joining us.
Thanks for having me, Willow.
So how would you characterize deal flow in the space right now?
Deal flow in the energy space is really robust. That's driven by a couple of things. In North America, it's been driven by this incredible period of discovery of unconventional or shale resources. Recoverable energy resources in North America have probably increased by about 3 to 4-fold in the last decade, and that's because the industry has discovered how to unlock both oil and gas from shales. So a consequence of all that discovery has been now the industry needs capital, and there's been lots of deals around that.
Now, interesting because the lunch panel today with Brazilian businessman Ike Batista, guests were asked to identify pink swans, positive shocks to the economy. And he went right to shale and the carbon sequestration technology that pulls the CO2 and turns it into biomass or biodiesel. Is he right about that? Are those likely to be positive shocks to the economy?
Absolutely right. And the reason is because it provides the global economy with the opportunity for a long period of relatively low-cost, affordable energy. And I think the other thing on the pink swan front that people may not be anticipating is, right now there's a lot of concern in the environmental community about the impact of shale drilling and hydrofracking and these things. But actually, I think the industry is going to learn how to do that in a much more environmentally friendly manner. And the pink swan that we may see is that not only can we recover, energy at a low cost, but we can do it in an environmentally responsible
manner. Well, that's interesting
manner.
because environmentalists tossed out yet a new study today suggesting that this type of extraction may be even worse than the environmental byproducts from coal. But you're suggesting this could actually be a positive, this environmental debate. Will it mean that the industry is required to implement best practices kind of right out of the gates and not wait to have to then recover from an accident as we've seen with oil spills or with fracking?
That's exactly right. And I think what's happening here, remember the basic technology here, hydrofracking, has been around for 50 years, and there's really never been a major environmental problem associated with hydrofracking. I think the new issue is that we may apply hydrofracking on a massive scale in the United States and around the world, so that the requirements that it be more environmentally friendly and studied more carefully are going up. And I think the industry is just beginning to react to that. But I think, I sat through a meeting last week with some executives from Schlumberger, and they were showing some new green technologies they were developing around how the materials used to frack with, and it was very impressive about the progress they had made in such a short period of time in terms of beginning to make it a more benign process environmentally.
Is this deal space getting overheated right now? Are there so many investors in the space looking at deals? I know you do the majority of deals in the shale space, but are prices getting a little hot?
I would say it's the other way around now, actually. I think the buyers of deals are getting great deals right now. And that's because there's so many deals. Because we've had this enormous period of discovery, the amount of assets available to invest in has exploded. And in fact, the amount of assets has grown much more rapidly than the capital available. So what's happened, of course, is that the capital's getting good deals.
Capital's getting good deals, but do these deals not then require additional capital investment in order to get that asset into, whether it's our trucks or even at some point our cars?
Yes, but again, that's all baked into the upfront price, right? So when someone makes a decision to buy an asset, they have an expectation about the additional capital that they're going to have to spend. And let me give you some kind of metrics to think about how these things work. And I'm talking about there've been a number of shale joint ventures where we've seen the big companies invest in the assets of smaller companies. And there've been now some $30 billion worth of these things, so a lot of them. And in a typical deal, you put an upfront payment of $1 up, you spend another 50 cents to get to positive cash flow, so you're into it for $1.50, and the ultimate payoff is about 7 to 1. So you earn $10 in profit for maximum cash out of pocket of about $1.50. So it's a heck of a deal from the point of view of the buyers.
Ralphie, thanks for joining us. You clearly had one of the hot topics of today in the energy investment and shale space.
Great.
So thanks for sharing
Willow.
some of your insights with us.